This is your New York State Tax Update, and I'm Tom Bridgman. 2020 was a very interesting year for New York and everywhere else. Before we delve into just how interesting it's going to be for us coming up this tax season, I want to take just 1 minute to step briefly into the past. In particular, I want to return to 2019. Some of you may remember 2019. It was glorious. In 2019, we were doing 2018 tax returns, and one of the factors we were dealing with that year was that there was no extender bill, so that certain things had expired, including the PMI deduction. Congress got around to fixing that in 2019, restoring it retroactively for 19 and 18, allowing us to go back and amend 2018 to claim it if it would have benefited the taxpayer. The reason that I'm giving you this historical lesson is that New York had removed that line from their itemized deduction form because it wasn't a deduction at the time, so there's no place to claim it. So if you go back to amend, it's not obvious that it is allowed for New York State purposes. And further adding to the confusion, some tax software disabled the connection between the federal and state returns for PMI, so that if you go back and amend the federal to see if it'll make a difference and you put it in, it may not automatically flow to your state return. So you may need to make a second entry at the state level to get that deduction to happen. The proper place on 2018 was line 11 of the IT 196, which is where you report mortgage interest not reported on a 1098, which makes sense. The only place you're going to find this information is on New York State's webpage for updates. It's not in the instructions and obviously not on the form, so you have to know where it's supposed to go and then take whatever action you need in your software to make sure that it goes there. That's all the time we're going to spend in the past, so I'm going to drag you, kicking and screaming perhaps, to return to the year currently in progress. So the CARES Act passed Congress at the end of March this year, and New York reacted fairly decisively shortly thereafter to block it for state purposes. This makes sense from a financial point of view for the state, but it is going to complicate our lives somewhat significantly for doing New York State tax returns for this year. New York, like about half the states that rely on the Internal Revenue Code for the basis for state taxation, automatically adapt to changes to the code as they're made by Congress, unless the state takes explicit action otherwise. Other states have what's called static conformity. They pick a particular date and time where they liked the code as it stood, and that's the version of the code that their state tax laws refer to. When it comes to the CARES Act, New York has temporarily switched from rolling conformity to static conformity, and that is going to give us some headaches. We've had specific instances where New York has decoupled from changes in the past, usually very targeted. For example, 2002, New York decoupled from bonus depreciation, which still exists to this day. 2 years ago, 2017, I guess that's 3 years, New York decoupled from certain provisions under Tax Cuts and Jobs Act, including alimony, moving expenses, itemized deduction treatment, and those being targeted were fairly simple for us to deal with, even though keeping two sets of rules in our head could be a little complicated. For this year, we're dealing with complete rejection of all rules imposed by the CARES Act and any changes to the Internal Revenue Code until the end of 2021. And this takes place not only for personal income tax, but also for corporate tax, UBT for New York City, general corporation tax. And as the CARES Act in particular made some retroactive changes, it's going to make our lives difficult as we try to figure out what's best for our client as we look at the options available. New York Tax and Finance reinforced that this is the case, issuing a notice that states that New York State returns should not be amended, even if the federal return is amended, for any changes due to the CARES Act or anything after March 1st, 2020. And this would include not just changes for 2020, but also any retroactive changes that were introduced by CARES that would theoretically have affected New York, but now will not. So what does that mean in practice? Well, we are left to make our best guess in most cases because New York has not issued any guidance as yet. So let's quickly run through the major CARES Act provisions and what the potential problems and treatments will be on the New York State return. First up, let's look at COVID-related distributions out of qualified plans. There are two provisions of interest to us here. The first is that for federal purposes, the tax on such distributions can be spread over 3 years if the taxpayer chooses, and if the taxpayer wants to return the money to the account or to another retirement account, the returns where tax was paid can be amended and some or all of the tax refunded, depending on how much was put back into the plan. Those provisions are not in the Internal Revenue Code as it existed on February 29th, 2020, so we're left to wonder how New York is going to deal with those provisions. For the first part, it seems likely that New York will insist on all of the income to be taxed in the current year, and then there'd be adjustments in future years for income that was getting taxed in the federal that had already been taxed for New York. Assuming that is true, what's less clear is how New York State will deal with any amended returns resulting from funds being returned into a retirement account. We have that notice indicating that returns shouldn't be amended solely because of anything to do in the CARES Act, which this certainly is, but if New York does not allow for some kind of adjustment for that income, then income could end up being taxed by the state twice. This is going to be a common refrain for this presentation, but we're going to need to await guidance from New York State to know exactly how this will be treated. Similarly, CARES Act allows taxpayers to borrow more money from a 401k or similar plan if they're an active participant, and the version of the revenue code that New York State is referring to doesn't allow loans of that magnitude. There's some speculation that means New York State will seek to tax the amount of loans that are over the limit, but that raises the question of how New York State, or indeed how we, will know that's the case. It's going to be very difficult to administer if that is true. And again, if it is true, how will New York State adjust for any balances that are repaid to the loan? Because otherwise, when they're taken out for retirement purposes, the taxpayer will end up being taxed a second time. CARES also finally addressed a drafting error in TCJA relative to qualified improvement property and its treatment for tax purposes. At the federal level, QIP is now 15-year property and is eligible for bonus depreciation. We know that New York State doesn't recognize bonus, and we know how to deal with that on the IT 398, so that will not be an issue going forward. And if past returns were amended at the federal level to claim bonus, New York State would simply ignore that. The more complicated question here is how New York's going to treat the difference in class lives, which I think might be a unique problem. I don't recall that we've had this before. So the federal treatment will now be 15-year property, while New York State is going to keep it at 39-year property as set by TCJA. Assets that were placed into service previously won't be a problem. Even if federal returns are amended, the New York State return is essentially correct. The issue will be going forward, as well as for new qualified improvement property placed in service in 2020 or beyond. And who knows, we may find cases where New York State decides that maintaining the differences is too complicated, and so despite not being in the Internal Revenue Code of February 29th, 2020, they're going to adopt some of the changes anyway. Another major issue is going to be the treatment of net operating losses. TCJA made some significant changes from what we were used to, eliminating carrybacks and putting a limitation on the amount that could be claimed in the current year. And CARES reversed that temporarily, and we have a 5-year carryback and no limitation. Since New York State had not decoupled from TCJA in this area, those rules would seem to still apply for the state, which would mean no carryback allowed, and the limitation remains for carry forwards. If that's true, then it seems that if the taxpayer elects to carry back the NOL for federal purposes, any loss that is used up in those 5 prior years will be completely obliterated for New York and unavailable for any claim going forward. The excess business loss rules that TCJA imposed were similarly suspended temporarily. And for New York purposes, it seems that those limitations will remain in effect because, again, New York did not decouple from those provisions of TCJA. The final retroactive change we're going to look at was the business interest deduction. Fortunately, most taxpayers aren't affected by this because it only applies for relatively high gross receipts. But for those taxpayers who are subject to it, New York State is still going to be abiding by the TCJA rules as far as we can tell. The final CARES Act provision we're going to discuss is the $300 above the line charitable contribution adjustment, which is going to allow non-itemizers to take up to $300 in cash contributions off their AGI. We expect New York State's not going to recognize this as it's part of the CARES Act. This is, however, a permanent change to the IRC, which means it's something we're going to have to come back and deal with in 2022. So you may be getting the sense that 2020 is going to be an interesting year for New York State tax purposes, but we are by no means done. Another issue for both New York State and elsewhere is the interplay between taxation in different states. One of the first tax issues to make the news way back in April was the question of whether New York State was going to be taxing volunteer medical professionals who had come to the state to help out when we were being hit with our first wave of cases. And I hasten to point out here that by volunteers we mean employees who are volunteering to come to New York State and work, not people who are volunteering their time. Even New York is not mean enough to tax people's time. What we're talking about here is people that normally work in another state but volunteered to come help out in the New York healthcare system. And as such, they're subject to the same rules as any non-resident working in New York State. And that's summarized here. They would have to file a New York return and potentially pay New York tax if they have any income from a New York source, such as a New York hospital, and if their New York AGI is greater than their standard deduction. And this is true regardless of whether there was New York tax taken out of their paycheck and regardless of whether the income is reported to New York State on their W-2 at all. There was some confusion about the 14-day rule, where some people apparently thought that if you were working in the state for less than 14 days, you were exempt from these rules, but that's not the case. The 14-day rule simply applies to employers. If the employee is working in New York for more than 14 days, the employer is obligated to deduct withholding and report it on the W-2. And just to clear up a possible point of confusion, I want to make this clear that the rules are different for residents in determining their filing threshold. The filing threshold for residents is $4,000 of federal AGI plus any New York additions. $4,000 is relatively small. It's half of the 2019 standard deduction for a single person. And also note that this calculation has to take into account any Social Security benefits that are taxable at the federal level, even though they're going to get subtracted for New York State tax purposes. The other big question this year has been home office deductions, both for residents and non-residents. It's probably the most common question I've had in the second half of the year from my clients as to whether they should be taking into account any expenses they have for working at home. So because New York did decouple from these TCJA changes, the prior rules still apply for New York residents, and they theoretically can qualify for home office deduction. The rules for that are the same as they always have been and are summarized in the flowchart that comes from the 2017 IRS publication. The principal hurdle here is going to be whether the office meets the convenience of the employer test, which New York has very particular views about, and we're going to talk about that in a moment. Taxpayers who are not New York State residents but who work for a New York State employer and were typically commuters prior to the pandemic are also interested in whether that by working at home they can be exempt from filing a New York State tax return and paying New York State tax. And the same test applies here. New York is going to consider you to be working for a New York State employer and earning New York source income unless your home office location qualifies as a bona fide employer office. So in both those cases, we have to look at New York's definition of what it means for the office to be set up for the convenience of the employer. And this is spelled out in a 2006 tax bulletin, which has survived court challenges and other challenges. You can find the full text of the bulletin in the handouts, and it explains all the factors quite clearly for a tax publication. But basically there is a primary factor, and if you meet that primary factor, then you're golden and don't need to go any farther. Otherwise, you have to meet several other factors, 4 secondary factors and 3 other factors. And to be clear, if you don't meet this test, then the state considers that your home office is set up for your convenience, not your employer's convenience, therefore isn't going to qualify you for any special tax treatment. So the primary factor, the golden ticket as it were, is whether your home office is at or near specialized facilities that can't be made available near the employer's place of business. The example in the bulletin is an employee who lives next to a vehicle test track that is located outside of New York State. The bulletin goes on to say that simply having specialized equipment installed at or near your house isn't sufficient because presumably it could be moved, and therefore it's only located out of state because it's convenient for the employee, not for any benefit of the employer. Since most people aren't going to be able to qualify under the primary factor, they are going to be turning to the second and tertiary lists. There are 6 secondary factors, and the taxpayer needs to meet 4 of them, and then there are 10 other factors, and the taxpayer also has to meet 3 of those. They're summarized here on the slides. They are in complete detail in the handouts, and I'm not going to go through them because most taxpayers aren't going to qualify, but if you think you have someone that might, definitely read the bulletin to make sure that the appropriate number of criteria are met. Now, New York was one of the leaders in applying this test, but other states have taken notice and followed suit. Last year, Connecticut passed a convenience of the employer test, but it only applies if the other state, such as New York, has a similar rule. So that would mean for the reverse situation from what I was discussing previously, if you have a New York resident who was commuting to Connecticut prior to the pandemic and is now working out of their New York home, that income is going to be considered by Connecticut to be Connecticut source income because the office at home is not for the employer's convenience. New Jersey also has a similar rule, but they're going further and looking into whether there are other measures they can take to address what they view as the imbalance between New York and New Jersey treatment affecting New Jersey residents. Another possible problem is that some taxpayers may get hit with double taxation. The Tax Foundation claims that this already exists between New York State and Vermont, because according to them, Vermont's statute explicitly denies the credit if the work wasn't actually done in another state. So if we have a Vermont resident who normally commutes to New York and is now working out of their Vermont home, Vermont's apparently going to say no credit is available because even though New York views that as New York source income, the work is not being physically done in New York. Now, I did go look at Vermont's statute in preparing this presentation, and as a non-lawyer, it's not clear to me that it explicitly states what Tax Foundation says it does, but this still could be an issue because many state statutes are vague or silent on this point, and we're probably going to see challenges and disagreements. And no talk about interstate tax issues would be complete without mentioning statutory residency. New York has a very aggressive stance on this and has audited people in the past and often succeeded. Generally, when a state has a statutory residency rule, if you are physically in the state for more than a certain number of days and meet other conditions, the state will consider you to be a resident even if you have not terminated your domicile at your previous state of residence. This also has the potential to lead to double taxation because anybody taxed as a resident is going to get taxed on all of their income regardless of where it's earned. And again, depending on how the resident tax credit statutes are written for the applicable states, they may not apply in this case. Any non-New York residents that have relocated to New York for the duration of the pandemic and are working from a location here may be subject to these rules if they've been in the state for more than 183 days and if they have living quarters in New York State. You might think we've had all the fun we could possibly handle, but we've got to tackle the tax treatment of the Paycheck Protection Program and EIDL funds and how that's going to affect New York State returns. Once again, we have no guidance yet from New York State and not any applicable prior situations that give us a lot of clues as to how this is going to be handled. What we know is that the CARES Act explicitly designated any PPP funds that were forgiven as canceled debt, and then specifically went on to say that in this case, such canceled debt was not going to be considered part of gross income. So this is a federal law, but it did not amend the Internal Revenue Code. So the version of the code that New York State is adhering to doesn't have any provision that would apply in excluding this forgiven debt income from being considered taxable income. The situation gets stickier because we also have the IRS weighing in that as it stands right now, they don't consider any expenses paid by PPP funds that were forgiven to be deductible for tax purposes. While there's lots of unhappiness about that, and Congress has made clear it would like to change that, no action has been taken at the time I'm recording this, so we'll have to wait and see. So if we had to guess what New York State treatment is going to be, the CARES Act explicitly says any forgiven loan amounts are COD income and did not specifically amend the IRC to exclude PPP forgiveness. So it's quite possible that New York State is going to consider forgiven income to be taxable unless they take some explicit action otherwise. And if that's the case, where the income is not taxable for federal purposes, but is included in income for state purposes, how are we to deal with the expenses if they're not deducted at the federal level? New York doesn't have any general provision for deducting expenses that weren't allowed federally. There is no adjustments to make for a Schedule C for the state return, for example. EIDL funds are also interesting. EIDL loans seem to be straightforward. As long as the proceeds were spent on business expenses, then they would be deductible, and the interest paid would be a business deduction as well. It's a different story for EIDL grants. Many people feel that grant income is going to be taxable income, both for federal and state purposes. We haven't seen anything either way yet to indicate whether or not that's true. If it is true, then expenses paid by the grant funds should be deductible. If for some reason it's not true and the EIDL grant is not taxable income, then we have the same problem with expenses that the IRS is citing for the PPP loan forgiveness, and that expenses paid out of tax-exempt income generally aren't deductible. We also have the complication that the EIDL grant, as it stands now, reduces the amount of PPP loan forgiveness available, in which case some of the PPP loan would remain a loan, and that would allow us to deduct some expenses. You can probably guess what I'm going to say here, but hopefully we'll have guidance out of the IRS and New York to address these issues before we get too far into tax season. So those are the major changes, but there are other things to discuss as well. First, I want to mention 529 distributions. The 2019 Secure Act modified how 529 funds could be used. Last December, there was some question as to whether New York State was going to go along with those changes or not, and the answer is they are not. Both paying off student loan debt and paying for apprenticeship programs are considered non-qualified expenses for New York purposes, and as such, any earnings will be taxable. And to the extent there was any credit taken back to the beginning of when the plan was opened, an allocated amount is going to be recaptured on the current year state return. And that's going to apply for 2019 returns as well. So if you didn't take that into account on a client's 19 return, now would be the time to amend it to fix that. For a long time, New York has had a credit for taxpayers who have long-term care insurance. That credit does still exist, but it's getting somewhat tightened. So you can still carry the credit forward indefinitely, and it's still 20% of qualified premiums, but for 2020 and beyond, it's capped at $1,500, and you can only claim it if your New York AGI is under $250,000. Tax and Finance will now have the ability to make certain additional corrections, what is often called math errors, on tax returns without any intervention from the taxpayer. If they determine that the taxpayer qualified for New York State or New York City Earned Income Credit, then they're going to give it to the taxpayer if it wasn't claimed on the New York State form. And if a taxpayer took itemized deductions when the standard would have been more beneficial, the state can correct that for them automatically and adjust the refund or tax due. The Empire State Child Credit, which is New York's counterpart to the child tax credit, has been adjusted somewhat. Although this passed in this year's budget, it doesn't take effect until 2021. So some people may have heard of it, and I want to bring it to your attention so you know that your software is not missing something. Under the new rules, the age requirement that the child has to be at least 4 years of age will no longer apply if the taxpayer's AGI is under $50,000. But again, that doesn't take effect until 2021. And I want to take a moment to look back on penalty relief that was available for 2019 returns. So New York State, like the federal and many other states, extended their filing and payment deadlines. For any returns that were due April 15th, the deadlines for both filing and payment was extended to July 15th. That did not affect returns that were due earlier, such as partnerships and S-Corp returns that were due in March. However, unofficially, the state has been very generous in waiving late filing penalties for S-Corps and partnerships that were filed late. I've managed to get a couple of those myself, so it does not hurt to ask, even though no formal relief was announced. New York tried to confuse people by shuffling their estimated payment dates. So the first payment was extended to July 15th, but the second payment remained due on June 15th. So New York has said that for purposes of figuring out estimated tax penalties, the second payment is the first payment and the first payment is the second payment. Or more clearly, whatever payment was made first is going to be the first payment, and whichever payment was made second is going to be the second payment. And finally, if any sales tax filers were late with their returns or payment, returns that were due March 20th were not subject to interest or penalties if they were filed and paid by June 22nd. That applies for both quarterly and annual filers. And in the It's About Time department, New York State is the second to last state to allow electronic signatures on tax documentation. If you're curious, the one holdout is Hawaii. So the law authorizing this was very brief. It's in your handouts. It's a couple paragraphs, and basically leaves up to the Commissioner of Tax and Finance to set out exactly what's going to be compliant. And despite this passing in August, we've yet to get any guidance about what is going to be a compliant electronic signature. In fairness, they've probably been pretty busy. But nevertheless, people want to know. Practitioners like myself are eager to make sure that whatever we pick is going to be compliant. And the best we can do is look at the interim order, which expired back in May, that allowed temporary use of electronic signatures. But it seems likely that New York is going to require KBA, knowledge-based authentication, for any cases where the taxpayer is not signing physically in the tax practitioner's presence. There's been a lot of discussion in the mainstream press about how people may be underwithheld if they've had unemployment benefits, and that's definitely true at the state level as well. First of all, for New York, at least, withholding isn't mandatory. The taxpayer has to ask for it or has to specify it when they claim it. And even if they do have withholding, the rate is a relatively paltry 2.5%, and no local withholding for anybody who would be subject to that. So even someone who is getting state withholding and thinks they're covering their tax bill may be in for a surprise when their tax return is complete. Finally, a couple non-tax but employment-related issues. New York State has implemented mandated paid sick leave on top of their paid family leave from a couple years ago, and this is currently in phase 1, where affected employees are accruing time now. This affects employers who have 5 or more employees. Employers with up to 100 employees have to give their employees 5 paid days off per year. Larger employers have to give at least 7 paid days off per year. Employers with less than 5 employees don't need to provide paid leave, but have to provide at least 5 unpaid days per year. They can pay if they want to, but they don't have to. And finally, the catch-all slide of some of the other changes, but by no means all of them. There's quite a few relatively obscure credits. They get extended every year. But the ones I want to mention are, first of all, the middle class tax cut continues to be implemented. This has been phasing in for quite some time, and means that people in the middle tax brackets are paying slightly less tax than they were last year, all else being equal. The STAR program continues to evolve. The state is pushing people off the STAR exemption, which reduces their tax bill up front, to what they call the STAR credit, even though it's really more of a rebate, which gives them a check later, but it's potentially a larger amount. In your handouts, I put a flyer from New York State for new homeowners, but you can give it to anybody who isn't getting a STAR credit. If you look on their on their school tax bill, and there isn't a STAR credit or exemption listed, they should register, because there's no downside to it and it's just costing them money. Finally, it's a very interesting year to make any election-related adjustment, but for 2020, New York is going to have a new $40 or $80 for joint filers checkoff for campaign finance fund, which is similar to the $3 checkoff on the federal return. If you prepare New York State returns, I encourage you to subscribe to New York State's Tax Professional newsletter. You can go to this website here and register, and it gets mailed once a month or so. Lately it's been more or so than monthly, but when it does come out, it has good information in it that you might want to stay on top of. And that's all I've got for you. I realize that there's probably a lot more unanswered questions that you wish there were answers to, and I don't know when or if I'll have answers to those questions, but if there is anything that I can weigh in on, please send me an email and I'll do my best to answer it. If you're a New York, Connecticut ATP member, I'll be posting questions and answers in the member forum, so you can see everything there. If you're not a member, certainly consider joining. Thank you very much for your time, and I hope this was at least somewhat useful.